Welcome back, and this is part 2 for the housing lecture. So determining how much you can afford, price of the house and down payment are the two biggest factors. So how much you can afford comes down to how much monthly payment you can make. How much of a monthly payment you can make will dictate how much house you can buy. Now, let's say you want a much larger home that where your monthly payment can hold. The way you fix that is by having a larger down payment. That way, the amount you borrow is much lower. Pre-qualifications provided without charge. There was a time, believe it or not, that you had to find the home first and then they'll tell you qualify for it. It just created more problems and delays. Now you can go to the bank and they review your situation and they'll give you an idea. Look, this is the monthly payment we will approve you for, meaning that this is how much we can lend you on the home. Anything above this amount, you'll have to cover it with a down payment or by increasing the down payment. Size and quality. Purchase what you can afford. Work with a bank. Now, I'm just going to say this. The bank has an incentive to lend you as much as they can because that's how they collect interest and make their profits. So they are going to try to get you the highest number. That doesn't mean you have to buy that amount. You need to be sensible because after the mortgage, remember, you're still going to have some money on the side for routine maintenance and repairs. And this could be a problem. And the larger, more expensive the home, the more maintenance and repairs, or the more expensive those maintenance and repairs are. Your second or third income can include more desired features. Your second or third home, I said income. Your second or third home can include more desired features, meaning there's nothing wrong with what we call a starter home. As you get promoted at work or get higher salaries moving forward, then you can probably go ahead and get a better home. But once you choose you're going to buy instead of rent, then it's okay to not wait until you get your dream home, because once you're going to buy, remember, you may start building equity. This equity will help you buy that next home. So equity built on your first starter home plus better salary later can mean a much better home in the future, your second or third home. Handyman special needs, work but lower price. So the handyman situation, yes, you don't always need a contractor to get some things done in the house. Handyman is a viable way to get a little cheaper. Just always be careful with what you entrust a handyman to do versus a licensed professional. Find and evaluate a property to purchase. Selecting location. One of the main items, I'm going to mention two that are big in people's mind when they're looking for location: crime rates and the school district. People like to have or live in the zone where they belong to quality high schools, middle schools, etc. Be aware of zoning laws. You buy a home that looks like a nice place and a good area and all that, but next thing you know, one block behind you, they start building a chemical industrial plant because the zoning law allows it. So you also want to be aware of zoning laws and what's allowed and not allowed in your area. Assist the school system if you have children. Now, I'm going to say that you should assist the school system even if you do not have children for two reasons. You may have children in the future, but even if you do not, your resale value is better when you are in a good school system, when you belong in that area, that location. So just for the investment approach, you may want to consider that as well. You can get cheaper homes in less desirable school districts, but that just means that when you sell it, you're also going to sell it for cheaper. They hold value better in good school zones. Using a real estate agent, they present your offer, negotiate the price, assist you in obtaining financing, and represent you at the closing costs. When you are buying, the real estate agent gets paid by the seller. So this is a free service to you, in other words. There are some exceptions. If the seller is a sell-by owner, some sellers do not have a real estate agent involved, so they don't want to pay real estate agent fees. So then at that point, you may have to pay the real estate agent out of your pocket. And just the way to avoid that, avoid sell-by owner homes. Conduct a home inspection or hire an inspector. Due diligence. When you make an offer, what you're doing is you put in some, but it's called differently, but I'm going to say option money, but it does the same effect where you put a few dollars. It varies between the house itself and the area you're in, but you got to give them some money to pull it out of the market, like we say. And that gives you, let's say, about 2 weeks that they give you access to the home, so you can bring in inspectors and take a real good look at the house inside out. You can do any inspection you want, because if they find something, let's say termites, water damage, some really drastic things, then you have to make a decision to either negotiate the price again or just get out of the deal. And during that grace period, there is no harm, no foul. You don't have to pay anything like that. Now, once you get past that point, then you're somewhat committed. There's still some other contingencies, but at that point you are committed, and a larger amount of money that you would have deposited on escrow may change hands to the seller if you choose not to buy it. But do always conduct a home inspection. You definitely want to do that. A lot of people don't want to pay it could be anything $200 to $400. It really varies on location, but and the size of the house, but it's a few $100s that will save you a lot of headaches in the future. Lenders may require an appraisal. It says may require. It is true that it's not obligated, but I have never seen a lender that does not require an appraisal. And the reason is of the thing called loan to value. They have to manage their risk, and that will dictate your down payment as well. The house has to be worth a certain amount for them to justify the amount being lent to it. And it has to be with current market conditions. So it will be very rare of a lender that does not require an appraisal, which is different of a home inspection. Price the property, determining the home price. Now, before I talk about those two bullets, the real estate agent that you engage with, they can get this information for you. They'll tell you, look, these are comparable homes in the area that sold for this much recently, and they're similar to your home. And so the price of this house is reasonable, it's too high, it's low, etc. And they'll tell you that. But yeah, that's what they mean there by consider recent selling prices in the area. Your real estate agent will provide you with all those details so you can tell if you are getting a good price for the home. And I'm not saying they're getting a good deal. I'm just saying reasonable at least. If it's below, then you're getting a good deal. If it's above, then you want to think how bad you want that home, because now you're adding some other sentimental value on buying the home besides its actual market value. And that's fine as long as you understand what you're doing. Negotiating the purchase price. It's not uncommon that they list it for a number, you offer a number below it, they come back with a counter offer. This can go back and forth. And even after the inspections, even after an offer or a price is agreed upon, that grace period with inspections, you can do another round of negotiating. And then depending on what happens with appraisal, the buyer can renegotiate the price on the appraisal. The seller may not. So if the appraisal came under what the agreed upon price, it would be common for the buyer to say, well, I have to give you less money. And it has to do too, because the bank, the loan to value that I mentioned earlier, may restrict how much they can lend on the home. However, if the appraisal comes higher than the agreed upon price, the seller cannot exactly come back and say, no, I want more money now. Earnest money. Earnest money, this is an amount that you deposit saying that I really want to buy this house. I'm serious about it. Now, there are in the contract, there will be some reasons for you. They give you the right to walk away from the deal. For if this happens, then you can walk away the deal and get your earnest money back. If this happens now, if you just say, you know what, I changed my mind, I don't want to buy the home, and does not fall under one of those justifiable reasons, those contingency clauses, then the buyer gets to keep that earnest money. Earnest money, the amount depends a lot on the price of the home. The higher the price, the higher the earnest money is going to be. The finances of home buying, obtaining financing, determining the down payment. Sources include, okay, so as I mentioned earlier, how much you can afford monthly is going to eventually dictate what they're going to lend you, and so on. So determining the down payment is, if I can afford this much, but I want a much larger home, then you have to put more down payment. Another thing too is that the bank is going to require some minimum down payment. So let's say you can afford a $300,000 home on your monthly payment. It doesn't mean that they will lend you the entire $300,000 if the property is worth $300,000. They still want to have some equity built in from the beginning. And that's why you see that 20% in that second bullet. If you're not going to do 20% as a down payment in the $300,000 example, it will be $60,000, which is a significant amount. So if you say, like, you know what, I only got 20,000, 30,000, which is much lower than 60,000. The bank decides whether they want to lend you or not on that amount. If you qualify, that's fine, but they will more than likely include a private mortgage insurance, which is going to add a little more to your monthly payment, and is an insurance you're paying in case you default on the loan. And because your equity was less than 20%, the bank then has this money to protect themselves. And then the insurance kicks in and they cover part of it. It's still bad that you have to foreclose on the home, but this is the only way they'll lend you so they can recover that equity they took the risk on. So what happens is, after you make a few payments or the home value goes up and your equity is more than 20%, then you can stop making those private mortgage insurance payments. But that's typically what happens. That's something you want to keep an eye on, because a lot of people continue making the PMI payment even after they have more than 20% equity, because they didn't realize that they already had 20% equity, and that was not needed anymore. But obviously, the people that sell you the PMI are not just going to call you and say, hey, you don't have to buy our product anymore. You have to pursue it. Qualifying for a mortgage. A mortgage is a long-term loan on a specific piece of property, such as a home or real estate or other real estate. Consider various terms, sources for mortgage loans: banks, savings and loan associations, credit union, mortgage companies, your typical financial companies. Home is collateral for mortgage, for the mortgage. So the actual house, so this is a collateralized loan, and that's why you typically get better interest rates than a signature loan or credit card, because the home itself is the asset, the underlying asset on the loan. Factors considered include your income, how much money is coming in, your debts, how much money is going out, your credit history, do you pay your debts, down payment amount, as explained before, length of the loan, job stability, assets, and current mortgage rates. So length of the loan, what happens is, the longer the loan, let's say a 15-year versus a 30-year, your 30-year loan will have lower monthly payments, so you can afford a more expensive home. However, at the end of the loan, you would have paid a lot more interest. So that's a trade-off you want to consider. Job stability, that is a risk to the bank. If you have a job in an industry that has lots of ups and downs, a lot of layoffs and then hiring and things like that, then you are considered to be in a job that is not very stable and you're higher risk. Assets, just for more collateral purposes if needed. And current mortgage rates. Yes, the higher the interest rate, the less home you can afford. Lenders use 33 and 38% of gross income as guidelines for affordability of housing cost. This varies widely. It's a lot to do with cash in and cash out, but that's like a starting point. About a third of your income or somewhere in that range of your gross income is what they say that should be the reasonable amount that you can afford a home. This is an example for a monthly mortgage payment. We're just going to run through the numbers real quick. Let's say your annual income is $48,000. You divide that by 12. That's $4,000 a month. So you got your $4,000 a month. You multiply by that 38% we mentioned. So they're looking at $1,520 that is available for this type of debt. However, you may have other debts already in place, like your car loan and some other forms of debt. We're just going to do the car loan here, but assume that we're talking about adding all those other debts. So in this case, $380, you take that away. So you're down to $840. So the mortgage amount that they consider that you can afford is $840. And then from there, they can calculate, well, for $840 a month, this is the total amount of a home you can buy. But that's pretty oversimplistic way how to get an idea of how that works. Evaluating points and application process. Okay, so believe it or not, sometimes it's actually complex to explain the point thing, but at the end of the day, this is what it means. Let's say they're offering an interest rate of 5%. I'm just saying a number, and you want it to be a lower interest rate. There's some benefits of doing that, but there's trade-offs as well. So something to consider. You can literally just pay money to bring down the interest rate. How much and how many points you can buy, your banker will discuss that with you. There are some rules of thumb. They say each discount point is equal to 1% of the loan amount, but that's not a fixed number. That's just about a rule of thumb. That's the typical thing, but it could vary. The application process, pre-qualification. They collect all your tax information, income information, credit, and they do a pre-qualification. So you can go out there and shop. Fee payment and obtain commitment. There are some fees to processing your application. Some have larger fees than others. Sometimes they don't have no fees if they have some kind of promotion. And then you go about finding a property. And as we mentioned earlier, the lender will more than likely ask for an appraisal after you found the property before you get the full approval. Getting approved for mortgage, it's an approval on both sides. You as a buyer have to be approved with your credit history and income, but the person selling the property itself has to be approved that has sufficient value to justify that loan. So it's the pre-qualification is you as the buyer, but the appraisal has to come in to qualify the property. So fixed rate, fixed payment mortgages, this is the more common one. Conventional mortgage, you get a fixed rate, so your interest rate doesn't change over the life of the mortgage, which at that point then means that your mortgage payment is fixed. Now, it's one thing to understand. Your monthly payment is going to have your mortgage payment, which is the actual loan. There's going to be then some money they collect for future taxes and insurance. Because taxes and insurance change from year to year, or may change from year to year, that amount that they collect a month changes. So your monthly amount they collect is not going to change month to month. Typically, if there's a change, it'll be year to year. But do understand that there is a little bit of variation to expect on your monthly payment not because your mortgage or your loan is changing, but because taxes and insurance changed. So that's something to keep in mind. So fixed payment on the home loan, that's true. However, your monthly payment may vary because of other factors. Yes, mortgages can be 10, 15, 20, 25, or 30 years, but to be honest, it can be any amount of years, not more than 30. That wouldn't be normal. But between 0 and 30, it's whatever you qualify for and you choose. But the typical ones, those are the ones in 5-year increments starting at 10 years. Loan is amortized, which means balance owed is reduced with each payment. So you make a payment, the principal goes down a little bit, so the amount you pay in interest next payment is a little less. Government financing programs. They are VA loans, the Veteran Administration. So if you served in the military or in some qualifying job, you may get this, what we call the guarantee loans. The best example is people that have the Veteran Administration benefits, what we call the VA benefits, may buy a home with 0 down payment and without the mortgage insurance, the PMI we spoke about earlier, because then the VA is the one backing up the loan if necessary. We have the FHA loans, Federal Housing Authority. That also allows you to do it at a reduced down payment without having to incur PMI or some combination between that makes it easier for you to buy a home. Lower down payment and lower interest. That's really what these government programs do. There is an interest in the economy for people to have home ownership, so they have these programs to help. Adjustable rate variable payment mortgages. Let's first define it. Adjustable rate mortgages, also known as ARM. During the life of the loan, the interest rate increase and decrease due to market interest rates, but has a rate cap. Now they have a rate cap. There were times where they didn't, and it increased the risk a lot. So what it is that this will allow you to go in with a lower interest in the beginning, but then as time goes by and the interest rates in the economy and the market change, then the bank is going to tell you, hey, the interest rate went up, we're going to increase your interest rate. This will change your mortgage payment. But also if it goes down, then you benefit because then your interest rate will go down. They'll have a formula telling you if the interest rate moves this way, this is how much your will go up, and the other way, this is how yours will go down. However, the rate cap is if the interest rates just explode and go up very high, they can only increase yours by so much. There's a cap of how much they can increase it. A payment cap may limit the payment, resulting in a negative amortization extension of a loan period. This is less common, the rate cap, but saying that regardless of how much we're allowed to increase your interest rate, your payment can only go up to this point. However, that will affect the balance on your loan. So it may then stretch your higher payments for a long period of time, or your loan may then stretch out above the 15, 20, 25 years or whatever it is. There's different things that can happen. This is less common, but it is available. Should you pay off your mortgage early? Considerations: make sure mortgage does not have a prepayment penalty. Typically don't. It is most mortgages will not have a prepayment penalty, but always make it clear. Once you pay off your home early, any tax deductions you were enjoying, that goes away because there's no mortgage anymore. You may lose earnings on the money you used to retire this debt. Similar to the down payment, the more money you put in the home, the less money you put on your retirement accounts, brokerage accounts, investment accounts. So that's a trade-off. That's an opportunity cost. Before paying additional amounts on your mortgage, be sure to pay off your credit card balances. Okay, so some people like to tackle their mortgage because it feels good that you're paying off your home. But the problem is if your home is a 5% interest rate and you have credit cards with 12, 15, 20% interest rate, you should be paying those off first before your home and getting rid of those if possible. That's what they're trying to tell you there. Be aware of organizations that promise to set up additional payments on your mortgage, which is something you can do. Some organizations say, oh yeah, let's do it this way. And what we'll do is we'll organize this payment plan. And they show you all these schemes of how you're going to save money. But you don't need them. If you're going to make additional payments, just directly do it yourself to the bank or whoever give you the mortgage, and then in whatever amount you want. So, well, just be aware of those services. Close the purchase transaction. So let's say everything, inspections went well, the bank gave you the money that they approved the loan and the property, and you're about to close on the deal. It's just a matter of agreeing on the date in which you're going to finish it. What there's going to be this walkthrough that you want to do right before closing. Let's say if you close in the afternoon, do that walkthrough in the morning. If you close in the morning, do the walkthrough the evening before. You want to make sure that nothing happened to the property, like some massive damage in the last minute for X or Y reason. Anything could have happened, and then you may have to stop the closing until that gets sorted out. Closing involves meeting of buyer, seller, lender, and signing of documents. Typically, at the company that handles the legal side of this, the title, typically that's where it happens. People get together, sign documents. You don't always have to meet together. It wouldn't be abnormal that the buyer is signing and the seller is somewhere else signing the documents. Typically but they typically try to do the same day. It should be done the same day unless some special circumstances, but you don't have to be in the same room at the same time. Closing costs. These were mentioned earlier, but the title insurance company that I just mentioned, they do all that legal stuff. They have their fees for taking care of a lot of the legal documentations about the change of title and making sure the title is clean, as we say. There's appraisal fees, attorney's fees. The attorney's fees are typically within the same title company. It does not have to be, but it's very typical. Property survey, term and inspection, recording fees on the courthouse for the change of property, transfer of taxes. In other words, if you buy the house halfway in the year, there has to be a transfer of what taxes are your responsibility, the buyer, and what taxes are responsibility of the seller. Same with insurance. The issue of the escrow account, that's where your earnest money was in. So how that cash gets distributed, prepaid interest, real estate commissions, and there could be more items. It depends on the transaction. But these are not part of the down payment, not part of the loan, but you need to have some cash reserved to be able to cover this. These can be negotiated between the buyer and the seller, but to an extent. Your real estate agent can and your lender can explain those details to you very good, and because it varies a lot between each circumstances, each house, each different property. We will stop this video here and see you on the next one.